You're listening to the North Star Law Firm podcast. Clear, practical analysis of tax and bankruptcy matters that affect business owners and individuals. Each episode breaks down a current legal development and explains what it actually means for the people who have to deal with it. Brought to you by North Star Law Firm in Houston, Texas. Here's today's topic.
So if you are listening to this right now, there's a very good chance you might be losing sleep over an unreported foreign bank account.
Yeah, it's one of those things that just kind of sits in the back of your mind, right? Just quietly gnawing at you while you try to go about your day.
Exactly. But take a deep breath. I mean, while the situation is definitely serious, there is a well-marked road back to compliance here.
Right, but the catch is that you really have to move carefully. And more importantly, you have to move before the IRS finds you first.
Which brings us to the mission for today. Welcome to this special deep dive. Today we're unpacking a really fascinating and honestly kind of terrifying briefing prepared by Philip Zagatti.
Yeah, he's an attorney and CPA at North Star Law Firm in Houston, Texas.
Right, and we're going to map out exactly how ordinary people fall into this offshore reporting trap, what the penalties actually look like in the real world, and the specific pathways you can use right now in mid-2026 to fix the problem.
But I think before we even look at those solutions, we really have to tear down this persistent, Hollywood-driven myth about who actually ends up in the government's crosshairs here.
Oh, for sure, because when most people hear, international tax defense, they immediately picture billionaires with secret Swiss bank vaults.
Right, or oligarchs hiding assets in the Cayman Islands.
Exactly.
Mm-hmm.
But looking at the actual Houston case studies from the North Star Law Firm briefing, it's incredibly mundane.
Yeah.
The typical person facing this isn't a Bond villain at all.
No, not even close. The demographic reality is startlingly ordinary. I mean, it's an engineer doing oil and gas rotations overseas who simply left a checking account open in Aberdeen or Lagos.
Right.
Or it's a naturalized citizen who still has a modest savings, maybe a family flat back in India, Vietnam, Nigeria, or Mexico.
Yeah, or someone who just inherited a foreign account from a parent or married a spouse who already had assets abroad.
We even see people who just retired overseas completely unaware that the United States is practically unique in the entire world for taxing its citizens on their worldwide income.
Right, regardless of where they actually reside. So, I mean, if you are listening to this and mentally calculating how many overseas accounts your spouse has, this is where you really need to pay attention.
Because it's so easy to do.
It really is. It feels like leaving a gym membership open when you move to a new city. You just forget to close it. Except the penalty for forgetting to close this metaphorical gym membership could absolutely ruin you financially.
Yeah, and the danger lies in the statutory language itself. The reporting statutes, they do not require any actual intent to hide money.
Wait, really? None at all?
None. Innocent oversight and deliberate tax evasion, they trigger the exact same reporting obligations.
See, that feels like a massive trap. I mean, if innocent mistakes trigger these rules, we need to look at what those rules actually are. Because the briefing makes it clear how shockingly easy they are to break.
So true. And the centerpiece of this entire compliance nightmare is something called the Report of Foreign Bank and Financial Accounts. It's universally known as the FBAR.
And the most important thing to understand about the FBAR, according to the briefing, is its origin, right?
Exactly. It stems from the Bank Secrecy Act, not the Internal Revenue Code. Congress actually designed the Bank Secrecy Act to track capital flight, organized crime, and money laundering.
So that's why it casts such a wide, indiscriminate net over just ordinary financial behaviors.
Right. It was built for mobsters, but it catches school teachers who spent a few years teaching in Japan.
And that net has a very specific trigger, which is the $10,000 threshold. But the North Star briefing points out 3 hidden traps inside that rule that catch people completely off guard.
Oh, the traps are brutal. First, it is an aggregate limit. It's not $10,000 in one single account.
Right. So if you have 4 different accounts with, say, $2,500 in each, you might look at your banking app and think you're totally fine.
But you just crossed the threshold, and you have to file. That aggregate trap catches thousands of people every year.
Wow.
But the second trap is even more insidious, I think. The FBAR requires you to report accounts that you only have signature authority over.
Meaning you don't even have to own the money.
Exactly.
Yeah.
This routinely snares corporate officers, trustees, and just everyday people helping their families out.
Okay, let me make sure I'm visualizing this correctly. So I could just be an adult child, and I'm put on my mom's checking account back in Mexico just to help her pay her utility bills.
Oh, yes.
I don't own that money. It makes absolutely zero interest. But I am legally required to file this federal FBAR form.
You are. And that hits on the third trap perfectly. The reporting requirement applies even if the account's produced absolutely zero income.
That's wild.
The government does not care if the account earned a single penny. If you hit that aggregate $10,000 threshold across all accounts where you have your name or signature and you're a U.S. person, you must file.
And the craziest part is, the FBAR is just the beginning of the paperwork.
Far from the end of it, yeah. Alongside the FBAR, there's a whole family of IRS information returns for foreign assets that actually fall under the Internal Revenue Code.
Right, and without drowning in the alphabet soup of all those form numbers, you just need to know there are separate, highly complex forms for things like specified foreign financial assets.
And interests in foreign corporations, foreign trusts, and even large gifts from foreign persons.
So if you have a business interest in London and, I don't know, a bank account in Paris, you aren't just filing one document.
Not at all. You're filing a stack of them. And the key thing here is that each unfiled form for each year is considered a separate violation.
So if you've been out of compliance for 6 years, you are not facing one problem. You are facing dozens of separate problems, all stacking on top of each other.
Precisely. Which brings us to the financial gravity of this. Because a single missed form multiplies so fast.
Right. So say you missed a form for an account that made no money. It was an honest mistake. How bad can the penalty realistically get?
Well, we have to divide the penalty landscape into two completely different universes here. Non-willful and willful.
Okay, let's start with non-willful.
For non-willful violations, there is a civil penalty of up to a $10,000 statutory maximum adjusted for inflation for each violation.
I mean, $10,000 for an honest mistake sounds brutal enough. But looking at the briefing, the IRS actually used to interpret that rule in a way that just destroyed people.
Oh, absolutely. Up until a massive 2023 Supreme Court victory called Bittner v. United States.
Bittner completely changed the defense landscape, didn't it?
It did, because before that ruling, the IRS aggressively argued that the $10,000 penalty applied to each unreported account per year.
Right.
So in the Bittner case, the government took a Romanian-American businessman who had 272 accounts over 5 years, and because he failed to file the FBAR, they tried to fine him $2.72 million.
$2.72 million for a paperwork mistake where no taxes were even being dodged. That's insane.
And again, this was for non-willful conduct. But the Supreme Court finally stepped in and shut that down.
Thank goodness.
Yeah, they held that for non-willful violations, the penalty is assessed per unfiled report, not per account.
Oh, I see. Because you only file one single FBAR report per year, regardless of how many accounts you have.
Exactly. So that $2.72 million fine dropped to a maximum of $50,000, $10,000 per late report across the 5 years.
Okay, $50,000 is still a lot, but it's not almost $3 million. But that grace only applies to non-willful violations.
Right.
Because when we look at the penalties for willful violations in this briefing, it is genuinely hard to stomach.
It's devastating. The penalty is the greater of $100,000, or 50% of the account balance at the time of the violation.
And that is assessed per year, right?
Per year. The math gets gruesome very quickly. Because the IRS routinely stacks multiple years of audits together, a 50% penalty per year easily exceeds the entire balance of the account.
So if you have $100,000 in a savings account, year one, they take $50,000. Year two, they take $50,000. You were at zero.
Yeah.
If they audit a third year, you actually owe them more money than you ever had in the first place. They can literally wipe out a family's entire life savings just in penalties.
It is utterly draconian, which is why constitutional backstops are finally starting to emerge in the courts.
Right. The briefing highlights a 2024 11th Circuit decision, United States v. Schwartzbaum.
Yes, the court there ruled that the Eighth Amendment, specifically the excessive fines clause, actually applies to willful FBAR penalties.
So federal judges are finally beginning to recognize that assessing penalties that eclipse the entire value of the asset is unconstitutionally excessive.
Exactly.
Wait, but if the FBAR penalties are that devastating, what about those other information returns you mentioned earlier? The ones under the Internal Revenue Code. Do those have their own separate penalties?
They absolutely can, and they aren't any gentler. For example, the penalty for missing the form for foreign trust reporting can reach 35% of the amount transferred or distributed.
Oh, wow. 35%.
Yeah. And what makes this area so volatile is that there is an active legal fight over whether the IRS even has the statutory authority to summarily assess some of these information return penalties without going through standard deficiency procedures.
Interesting.
The tax court said no, the D.C. Circuit reversed them, but for taxpayers in Texas, which sits in the Fifth Circuit, that unresolved split provides a very real, very aggressive defense argument.
Wow. So if a single wrong move on these forms can cost you 50% of your net worth, and willful violations carry the shadow of criminal prosecution, it really makes you wonder how anyone gets out of this trap alive.
Well, the order of operations for getting back into compliance is everything. Stumbling blindly into a fix without a strategy is the worst thing you can possibly do.
Right. You have to choose the right pathway based on your specific level of culpability. So let's explore the main road home for people who simply made a mistake and had no idea these rules existed.
This is called the IRS Streamlined Filing Compliance Procedures. It's been open since 2012, and the briefing confirms it is still active right now in mid-2026.
The Streamlined program is designed specifically for non-willful taxpayers, right? And it splits into two distinct tracks based on where you live.
Correct. There is a domestic track for U.S. residents and a foreign track for non-residents.
So looking at the domestic track for people living in the U.S., the requirements are fairly strict. You have to file 3 years of amended tax returns, 6 years of FBARs, and you pay a miscellaneous offshore penalty equal to 5% of the highest year-end balance of the unreported foreign assets.
But if you meet the non-residency test for the foreign track, which basically means living outside the U.S. for at least 330 days in one of the last 3 years, the deal is dramatically better.
How much better?
You do the exact same filings, but the penalty drops to 0%. And under both tracks, all the usual failure to file, failure to pay, and information return penalties are completely waived.
Okay, a 0% penalty sounds like an absolute miracle.
Yeah.
But the price of admission is something called the non-willfulness certification.
Yes.
Reading about this in the briefing, it feels like handing a highly scrutinized homemade passport to a guard at a border crossing. Like, if they believe it's authentic and stamp it, you get safe passage. But if they think it's fake, you are in significantly worse trouble than if you hadn't shown up at the border at all.
That is a perfect analogy. That narrative is the single most important document in the entire case. You are certifying, under penalties of perjury, that your failure was non-willful.
Right.
And you have to tell the specific, detailed story of exactly how it happened. If you just submit a thin boilerplate story like just saying, I didn't know the law, you are practically begging for an IRS audit.
And I imagine if you submit a false narrative, it's even worse.
Much worse. You just converted a civil tax issue into a criminal perjury trap. The IRS processes these submissions, but they keep their full audit rights open.
Which begs the million-dollar question, who actually decides if you were willful or just non-willful?
Honestly, drawing that line is the hardest, most perilous judgment call in international tax defense.
Because willfulness in this context does not require an actual premeditated intent to defraud the government, right?
Exactly. The briefing notes that willful blindness or just recklessness is enough to hang you.
So what does that look like in practice?
Let's look at the facts that courts actively consider. Bad facts that lean toward willfulness include things like moving money between foreign accounts after you learned about the reporting rules.
Sure, that makes sense.
Or using nominees, trusts, or shell entities to hold the accounts. Instructing a foreign bank to hold your mail so nothing comes to your U.S. address.
Yeah, that all sounds pretty shady.
But here's the tricky one. Checking no on the Schedule B foreign account question on your tax return while you are actively using an offshore account.
Hold on. You're telling me that blindly signing my tax return, which, let's be honest, almost everyone does.
Yeah.
When their CPA hands them a stack of paper or they just click agree on tax software, that actually counts as willful blindness in federal court. That sounds legally absurd.
It might sound absurd, but several courts have held exactly that under the civil standard.
Really?
Yeah. By signing the return under penalties of perjury, the law presumes you read it, understood the questions on Schedule B, and deliberately lied when you checked no.
Wow. Okay, what about the other side? The good facts.
Conversely, good facts that lean toward non-willfulness include things like relying on a professional tax preparer who simply never asked you about foreign assets.
Okay, that's fair.
Or opening an account for ordinary daily banking while you were actually living abroad, rather than trying to hide wealth. Or simply inheriting an account and having absolutely no idea what the U.S. rules were.
But practically speaking, so many people are going to fall somewhere in the murky middle of those two extremes.
Oh, most real-world cases sit right in that gray zone. And this highlights a terrifying asymmetric downside.
What do you mean?
Well, if you improperly claim you were non-willful when your facts suggest otherwise, you have just handed the federal government a signed perjury exhibit on a silver platter.
Ouch.
But if you get scared and enter a willful program unnecessarily, you are volunteering to pay a 50% penalty that you never actually owed.
That is exactly why this judgment call has to happen in a privileged conversation with an attorney. You cannot guess on this.
Never.
But what happens if a listener is hearing this, looking at their own history of moving money around, and realizes they actually are in the willful category? Where is their off-ramp before the IRS knocks on their door?
For willful conduct, the designed exit is the IRS Criminal Investigation Voluntary Disclosure Practice, or VDP.
Okay.
This is the only program that actually buys you protection against criminal prosecution.
But that criminal protection comes at a staggering cost. The briefing notes you have to request pre-clearance, provide full cooperation, file your back returns, and submit to a negotiated civil penalty framework.
Right. And historically, that has meant paying that massive 50% offshore penalty on the highest balance year, plus a civil fraud penalty on the largest tax year.
That's a lot to swallow. But the North Star briefing outlines a massive timing dilemma happening right now with the VDP.
It really is a dilemma.
Yeah.
So in December 2025, the IRS proposed a major reform to the VDP.
Okay, what do they propose?
They proposed a fixed framework with a 20% accuracy penalty, a 6-year disclosure period, and a tight 3-month window to file and pay.
It sounds somewhat better than 50%.
It would be, but the comment period for that proposal closed in March 2026. And as we sit here in mid-2026, those reforms are absolutely not finalized.
Right, and we cannot speculate on how those proposed reforms will turn out or if they will ever take effect. But if you are a listener in this situation, this creates an excruciating catch-22.
Oh, completely.
Do you wait for these potentially better rules to be finalized and risk the IRS finding you first? Or do you file right now under the incredibly harsh current rules?
Waiting is an immense gamble, and you really have to understand why the IRS is finding people so much faster now.
Because of the automatic data matching, right?
Exactly. Automatic foreign bank data matching. A disclosure only counts as voluntary if you knock on their door before they receive your data.
And the foreign banks are basically reporting on everyone.
Pretty much. Through international agreements, foreign banks effectively act as global deputies for the IRS. They sweep their systems for U.S. citizens and automatically transmit that data back to Washington.
And if the IRS gets that data packet before you submit your voluntary disclosure?
You are disqualified from the program entirely.
Wow. Okay, given how aggressively the net is tightening on willful taxpayers, let's pivot to the absolute cleanest, most innocent cases. Let's say someone paid every single cent of tax they owed on their foreign income, but they just genuinely forgot to file the FBAR form itself. They owe no tax, just a piece of paper.
Right. Up until very recently, there was a guaranteed safe harbor for exactly this situation, called the Delinquent Submission Procedures.
How did that work?
You filed the late reports with a reasonable cause statement explaining why you missed them, and the IRS promised they would not impose a penalty.
That sounds totally fair.
It was. But here is the new trap for mid-2026. On July 1st, 2026, the IRS quietly deleted the Delinquent Submission Procedures from their website.
They just deleted it without any announcement. Why would they take away the one program for totally innocent people?
Because they have enough automated data now that they feel they don't need to offer carrots anymore. They only need sticks.
That's terrifying. No press release, nothing.
No press release, no formal announcement, just gone. The underlying substance of the relief still exists in the internal IRS manual. I mean, examiners are still instructed not to assert a penalty if the failure was non-willful and the taxpayer had reasonable cause.
But the guarantee is gone.
Exactly. The ironclad guarantee is gone. It is now a highly subjective, case-by-case judgment made by an individual IRS examiner.
Meaning the reasonable cause statement is no longer just a procedural formality. It is your entire shield.
It is the whole ballgame. It has to be a highly persuasive, customized legal narrative. How did the accounts come to exist? Why were the filings missed? What did you know? And what did you do the very moment you learned you were supposed to file?
Right.
A boilerplate statement that an examiner might have rubber-stamped in 2025 will leave you completely exposed to massive penalties today.
Man, hearing how complex and risky all these different programs are, I know exactly what some people are thinking.
What's that?
If this is so dangerous, why don't I just quietly amend my past returns on my own Or just start filing correctly this year and hope nobody notices the past.
I cannot state this strongly enough. That is called a quiet disclosure, and it is the one thing you must never, ever do.
So basically, a quiet disclosure is like trying to sneak past a sleeping guard dog by weaving a stake in its face.
It is exactly that reckless. If
Yeah.
you do a quiet disclosure, you forfeit all the penalty protections and criminal immunity of the formal compliance programs.
And worse, you are simultaneously handing the IRS a perfectly wrapped paper trail of your past non-compliance right.
Yes, you are admitting you did it wrong before. The IRS has openly stated they actively look for quiet disclosures.
Oh, wow.
Yeah, and if they catch you, they can and will use the quiet disclosure itself as evidence of your willfulness to evade the proper procedures.
Wow. So whether your case is squeaky clean, totally willful, or somewhere in that murky gray zone, the very first step you take dictates the rest of your life. Which brings us to the crucial question of who you actually hire to guide you through this. The briefing heavily emphasizes why an attorney-CPA combination is paramount.
It fundamentally comes down to the mechanics of legal privilege. Every offshore case starts with a very raw, very candid investigation. What did you know and when did you know it?
And those conversations need protection?
Exactly. They are only fully protected from the government by attorney-client privilege. If you have that same conversation with a standard CPA or an enrolled agent, their limited tax practitioner privilege does not cover criminal matters.
And as we've established, offshore cases always carry a shadow of criminal exposure.
Right. If a grand jury subpoenas a regular CPA, they can be forced to testify against you about everything you told them.
That's a scary thought. But I mean, the actual heavy lifting that needs to be done to fix the problem, like the currency conversions across 6 years, reconstructing foreign bank statements, preparing the amended tax returns, that is pure accounting work.
It is, and the traditional workaround has been a Covel arrangement, where a lawyer formally hires an outside accountant so the math is covered under the lawyer's legal privilege. But there is immense, undeniable value in having a dual attorney CPA handling the case. When one professional holds both licenses, the privilege analysis, the subjective willfulness judgment, and the hard tax math all happen under one roof in one privileged engagement.
With no handoffs and no gaps in your defense.
Exactly.
Which is exactly what Philip Sagatti provides at North Star Law Firm. We want to explicitly mention that you can find their resources and contact them at htx-legal.net and mn-legal.net.
Yeah, those are great resources.
And it is incredibly important to remind you, this deep dive is for general information only. It is not legal advice. As we've seen today, every single offshore compliance case turns entirely on its own highly specific facts.
The facts are everything, and the compliance landscape is brutally unforgiving to those who guess wrong.
So as we wrap up this deep dive, I want to leave you with a final, chilling thought to mull over. Think about that silent July 1st, 2026 deletion of the delinquent submission safe harbor.
Yeah, that was a huge shift.
It is a stark reminder of the government's power. These compliance pathways, the streamlined programs, the penalty waivers, they are acts of administrative grace. They are not statutory rights written into the law.
No, they're not.
The IRS can narrow them, change the rules, or make them disappear entirely overnight without a single press release.
Which means the absolute worst thing you can do when dealing with unreported foreign accounts is wait.
The road back to compliance is there, but you have to choose to walk it before someone else closes the gate. Thanks for joining us on this deep dive.
Thanks for listening to the North Star Law Firm podcast. This podcast is produced for general educational and informational purposes only and should not be construed as tax, legal, financial, or accounting advice for any specific situation. Listening to this podcast does not create an attorney-client or CPA-client relationship with North Star Law Firm. Tax and legal outcomes depend on the specific facts of each matter and on applicable state and federal law, which varies by jurisdiction. If you have a matter that requires professional advice, consult a qualified attorney or CPA licensed in your jurisdiction. For further inquiries or to start a conversation, visit us at htx-legal.net. Copyright 2026 North Star Law Firm. All rights reserved.